Core inflation, excluding precious metals, continues to be benign. As projected earlier, headline inflation is expected to rise further in the near term. It is expected to peak in Q3 of this year, primarily again due to food and fuel, and thereafter moderate. The underlying inflation reflected by core inflation excluding precious metals, which has been benign for some time, is set to align with core inflation towards the end of the financial year. Growth continues to be supported by the resilient domestic demand, sustained expansion in manufacturing and services activity, and robust exports. It reaffirms India's position as the world's fastest growing major economy. To sum up, the MPC noted that even though headline inflation is projected to increase, it is primarily on account of supply side pressures caused by food and fuel. It is not getting broad-based. Core inflation continues to remain moderate, and it is expected to decline after peaking in Q3. Growth, albeit resilient, is expected to be lower in this financial year. The outlook, however, is hazy because of the uncertainties regarding southwest monsoon, El Nino, geopolitics, and global trade policy. There is a need for greater clarity to emerge, especially regarding inflation, its path, and composition before taking any policy action. Any such action would also have to consider the need for recalibration of policy rates in line with the evolving growth inflation dynamics, especially the normalization of the underlying inflation from its benign levels seen hitherto. Considering all these factors, the MPC voted to keep the policy repo rate unchanged. The MPC also decided to retain the neutral stance to respond appropriately to macroeconomic developments. The MPC underscored that it will maintain a close vigil and remain resolute in its commitment to align inflation with the target. I will now come to our assessment of growth and inflation. Let me first of all talk about growth. The supply side pressures caused by the West Asia conflict have eased somewhat since June 2026, leading to withdrawal of temporary measures undertaken by the government and normalization of key input supplies. However, the re-escalation of the conflict since the first week of July has amplified volatility in energy prices and renewed uncertainty about supply chains. Amidst persistent global uncertainty, domestic economic activity has exhibited resilience as reflected by the high-frequency indicators available for Q1. Early results of corporates for Q1 indicate healthy performance in the manufacturing sector. This is also corroborated by an expansionary PMI. Services activity too maintained its momentum in the wake of strong domestic demand. Private consumption continued to be driven by buoyant discretionary spending. Investment activity remains steady on the back of robust government spending on infrastructure and construction. Merchandise exports rebounded with double-digit growth. Services exports growth sustained its momentum. Overall, the Indian economy performed better than expected in Q1. Looking ahead, the prospects for agriculture are clouded by deficient and uneven southwest monsoons amidst El Nino conditions. The reservoir levels, which remain close to normal, bode well. The government's initiatives for crop diversification, including short duration as well as climate resilient crops, and water harvesting and conservation, inter alia, are expected to mitigate the impact of deficient rainfall. Although manufacturing sector may face cost pressures, the growing diversification of global supply chains should help mitigate the impact. Services sector is expected to maintain its buoyancy on the back of strong domestic demand. On the demand side, impact of weak monsoon on rural consumption may be partly offset by supportive allied sector activities and various government schemes. Buoyancy in services sector and steady employment conditions should support urban consumption. Strong capacity utilization, robust credit flow, and the government's continued thrust on infrastructure are expected to sustain investment activity. Net external demand is expected to derive strength from bilateral trade agreements, many of which have been recently concluded, and some of which are now being operationalized, as well as the market diversification efforts of our manufacturers. Renewed tensions in West Asia, which are disruptive of global supply chains, volatility in international financial markets, and weather-related shocks, however, pose downside risks to growth. Taking all these factors into consideration, real GDP growth for this year is now projected at 6.7%. This is 10 basis points higher than our previous projections. Q1 at 7%, Q2 at 6.4%, Q3 at 6.5%, and Q4 at 6.8%. The risks are evenly divided. Let me now talk about inflation. While CPI inflation increased to 4.4% in June after remaining below target for 16 consecutive months, it turned out to be lower by 30 basis points than what was our earlier projections. The increase in June was primarily due to higher food, fuel, and fuel-induced inflation in select categories such as restaurant services. Notwithstanding the pressure from higher input costs, core inflation, which excludes food and fuel, remain unchanged at 3.9% in May and June. Core inflation, excluding precious metals, was even lower, 2.3 to 2.5% during this period. Going forward, El Nino impact on temporal and spatial rainfall distribution continues to remain a major risk, although proactive supply management and adequate stock of food grains should provide comfort. Global oil prices have remained highly volatile, with sharp two-way movements triggered by geopolitical developments. This blurs the near-term outlook. Although generalized inflation pressures continue to remain modest so far, the risks of second-round impact of higher food, fuel, and other input prices translating to broad-based inflation persist. After considering all factors, CPI inflation for this year is now projected to be 5%, 10 basis lower than our earlier projections, with Q2 at 4.7%, Q3 at 5.9%, and Q4 at 5.5%. Inflation for Q1 is projected at 5.3%, with risks being evenly balanced. Core inflation is projected at 4.3% for this financial year. Core inflation, excluding precious metals, is projected to be lower than core, although it is likely to align with core inflation towards the end of the financial year. Let me now